now on to the industrial snapshot. We'll have an overview of the stats, the current status, the trends, and the tenant perspective.
Okay, thanks, Ed. So looking at our latest industrial market stats, it looks quite different. We can see a sea of green on this chart, which we haven't seen for a while. So after long periods of record lows, we are starting to see vacancy increase across nearly all markets, with Wellington the only outlier this quarter, shifting down from 1.8 to 1.1%. So whilst vacancy is still fairly low, as we can see, Sydney is still only at 0.5%, this data shows some relief that our industrial tenants is on the way. So with vacancy trending upwards, we will start to see rental growth plateau and effective rents come down as incentives increase. Over to you, Ed.
Thanks, Gillian. One of the key differences this quarter is that e-commerce penetration, or the amount we buy online, is stabilizing as a result of cost of living pressures. For industrial occupiers, this is a glimmer of hope. As we have previously reported, e-commerce has been the primary consumer of warehouse space, which has led to the current low vacancy rates and upward pressure on rentals. There are still low levels of supply, and around half of the new stock coming onto the market over the next 12 to 18 months is pre-committed, but the new stock and reduced demand will certainly relieve pressures and rentals. As Gillian pointed out, and as alluded to in our last update, vacancy rates across all major capitals, with the exception of Wellington, in New Zealand and Australia have increased. However, Australia still has one of the lowest vacancies in the world, and in the absence of a major injection of uncommitted stock coming onto the market, we anticipate the vacancy levels will remain low for the foreseeable future. Landlords will be keen to maintain upward pressure on face rentals, and with the dampening demand, we are seeing the return of the incentive. Incentives of between 10 to 15% are now being negotiated, which is great news when compared to 12 to 18 months ago when incentives were not being offered in some markets. Moving on to the trends, the industrial market remains resistant to the economic tailwinds and global uncertainty. However, as the vacancy rates indicate, there is a softening of the market. Major agencies are reporting that inquiry levels are down on the previous 3 years. It is often the case that tenants are remaining and renewing leases in potentially suboptimal premises simply to ensure they have a home for the next 3 to 5 years. There is now evidence that rentals are increasing at a lower rate of growth, and it is anticipated the growth will plateau. Of course, owners, particularly the institutional owners, will want to maintain healthy face rents to maintain balance sheet credibility, so we anticipate incentives will continue to increase over the next 12 to 18 months. We also mentioned a few other trends that are emerging in the market. We have touched on the multi-story warehousing before, but now there is an actual product being delivered to the market. At this stage, it is only 2 to 3 levels and is located in the inner suburbs where higher rentals can be demanded in the order of around $400 per square metre, and can offset the higher land and construction costs. There has been strong interest from e-commerce users looking to satisfy their last mile requirements. Finally, as the other sectors, environmental initiatives are becoming increasingly relevant and in demand by occupiers. Not only can it contribute to a reduction in carbon emissions, it can also potentially lead to cost savings. For example, rooftop solar panels are being rolled out by industrial developers in response to occupier demand as a means of reducing energy costs through selling excess energy into the grid and passing it on to occupiers to offset the increased energy costs. So where do the opportunities lie? The industrial market has been a landlord's market for the past decade, experiencing year-on-year rental growth, decreasing vacancy, and dwindling incentives. And while the market is adjusting to lower demand and some better levels of supply, there is still little leverage for tenants, both in terms of the market conditions and lease conditions. And the sustained growth of the market has skewed the norm toward the landlord. In order to shift the needle on the barometer back in favour of the tenant, careful consideration of business needs, expert knowledge of the market, and experience and patience are essential. On the next slide, we'll look at some potential strategies that can assist in moving the needle on the barometer to a more tenant-friendlier situation. So despite some good news this quarter, the industrial market remains pretty tough for the tenant, which certainly limits the leverage available. Nevertheless, there are a number of strategies that we have used to improve an industrial tenant's position. Our negotiation strategies turn on the 5 key categories of costs, risk, flexibility, obligations, and guarantees. Whilst there should be attention given to costs in a market such as the current industrial market, driving down cost is not impossible, but it is a difficult proposition, and is arguably that better outcomes may be achieved by a focus on other factors such as risk or obligations. The strategy we often apply, particularly for multi-site occupiers, is a portfolio review in which we take a strategic view to identify opportunities to better align a client's property portfolio with its business needs in order to optimize its property performance. A topical example of this is a trend for a number of Sydney occupiers that are looking to relocate and consolidate their footprints to another city or further afield in order to take advantage of more favorable rents. Another strategy available is looking at mitigating risk and transferring certain obligations to the landlord via side deeds or through a variation to an existing lease. Everything is negotiable, but make no mistake, it's hard yards and takes skill and patience. A good example of this in the industrial sector is a commitment or obligation on the landlord to meet certain energy targets through initiatives such as solar power. Increasingly, we are negotiating provisions in a lease of this nature.